The 2020 SPAC craze, which set a record for the amount of money going into SPACs, has continued into 2021 with more and more money going into these investment vehicles. And what's become a bit of a Wild West within Wall Street, the SEC has opened up an investigation into SPACs more broadly to figure out what it thinks it should do in this space. And here's that news courtesy of Reuters saying that the SEC has opened an inquiry into Wall Street's blank check acquisition frenzy and is seeking information on how underwriters are managing the risks involved, said for people with direct knowledge of the matter. So it'd probably help to actually understand what a SPAC is for anyone who's not familiar. A SPAC is a special purpose acquisition company. It's essentially what this article says, a blank check company, where a group of investors called sponsors will pool together money into a public company, a company that they take public, but all it has on its balance sheet is cash, nothing else. It's not really a business. It's a blank check company. So it's a bunch of money sitting within the legal bounds of a corporation. The SPAC raises additional money through their initial public offering, that IPO, that pulls money from the public then to add to this pool, which eventually, if all goes well, is used to merge with a private company to then take that private company public without having to go through the more burdensome IPO process for that company directly, since the SPAC has already done it for it. You could see why a private company might want to go for this route, have a SPAC take them public as opposed to going public directly themselves, since that might require a lot less regulatory burden, and it certainly might be much quicker since the SPAC has already done the heavy lifting on the IPO side, and now all they have to do is merge. Of course, merging is its own regulatory burden with its own sort of set of requirements, but it's probably not nearly as tedious as doing an initial public offering directly as a private company. And that's what this article is getting at. It says that the SEC, which declined to comment, of course, has previously said it was monitoring the SPAC boom, but the letters are the strongest sign yet that it is stepping up scrutiny on such deals and the Wall Street banks that underwrite them, because the SPAC has already been taken public. So that sort of initial line of defense that the IPO process tries to do by forcing tons of disclosures isn't necessarily there, since the SPAC can just merge with the company without necessarily going through as much disclosure, which might open up the door for abuse, and that's what the SEC is concerned about. Reuters outlines this concern with SPACs, that the SPAC structure provides startups with an easier path to go public with less regulatory scrutiny than the traditional IPO route. But that regulatory scrutiny, at least the idea, is to give more information to public investors, so you know what you're actually buying, so you know that the company isn't hiding as much as it could hide if it was doing this more unusual SPAC route as opposed to a direct IPO. And the SEC warned investors against buying into SPACs based on celebrity endorsements. We're seeing everyone and their dog opening up a SPAC. Instead, it was closely watching SPAC disclosures and other structural SPAC issues. I was actually a bit surprised that it's taken this long for this sort of inquiry to go public, because the SPAC craze was absolutely insane in 2020, and it's even more insane in 2021. Before I get into that data, here's some of the upsides of SPACs as brought to you by CB Insights. And you can see that the big ones I really want to highlight here are speed, since the SPAC merger process can take 3 to 4 months, much shorter than the 24 to 36 months in a traditional IPO, as the IPO requires so much due diligence and disclosures to the SEC and to the public. That's what takes so long, and that's what prevents a lot of companies from going public in the first place. It's a huge legal expense and a lot of time. You got to devote talent towards it. That's expensive. It's a time-intensive process. Whereas with the SPAC, all you have to do is agree to merge with the company, and you'll swap documents there, but it's not nearly as much of a regulatory burden as doing a traditional IPO, in most cases at least. And the other one here is on the benefits for sponsors. The SPAC IPO process is relatively simple, and the shell company faces fewer regulatory hurdles than traditional IPOs. This makes this route potentially easier than, say, raising a new VC fund, since all that the company has to take public is a cash entity. There's not a lot of disclosures to do there. It's a company that is full of cash and doesn't have any complications with it. So it makes it much easier to take that company public as opposed to taking a very complicated tech firm public directly. So it's easy for the SPAC sponsor to raise money, comparatively speaking, than actually acquiring that company and then taking it public in a sort of reverse order. But on that point of sponsors here, under the downsides to SPACs, this is where a lot of the concern comes from. The sponsors, the people who create the SPAC, often give themselves a handsome share of the eventual warrants, as they're called, if not all the warrants, to buy the actual SPAC company at a significant discount, usually not much over the actual value of the initial SPAC shares. So it's sort of like an option play on the company that they eventually acquire. But because of that, there's a lot of incentive problems in many cases. This traditional structure, it says 20% of the SPAC shares often are reserved as warrants to the sponsor, pretty much free of any other expense to them. So they get a massive chunk of that equity in many cases when they make a deal. And that's even if they make a deal with a pretty poor company. So you have to really watch out for that if you're looking to invest in SPACs. Obviously, none of this is financial advice. You should do your own research in any way, because there's a lot of room for abuse within a SPAC. And a lot of it stems from the incentives with a sponsor who might be incentivized to do a bad deal just because they get such a big discount on the back end with these warrants and this massive warrant share that they get once the company actually merges with the SPAC. And the reason that's a concern at all is because of this point over here, time constraints. Most SPACs only have a couple of years to actually make the acquisition. So if you're getting up to a year and a half, the SPAC sponsor, if they want that fat payday with the extra equity they'll get from their warrants, they might force a deal before the end of that 2 years rather than have the SPAC dissolve and all the money get returned to investors and they make out with pretty much nothing. That would be very unfortunate from the sponsor's perspective when they could make a quick buck using the sort of warrant. I don't want to call it a trick since it is very common and it does make sense. They want an incentive to actually open up the SPAC in the first place, but you have to be careful since not everyone's incentives are going to be aligned in this case when the sponsors have so much to gain even from a poor deal. And the sponsor here is very important since sponsor quality, as noted here by CB Insights, the initial investors are betting on the sponsor, not on the company, because there is no company when you buy into a SPAC. You're buying into a cash pool. You're really just putting your money in a fund, if you want to look at it that way. And the sponsor needs to put that fund money towards something good. If they don't, then you're probably going to lose too. So you're betting on the sponsor being a good capital allocator. And not everyone is, because if everyone was, then, well, everyone would be a trillionaire. But, well, that is obviously not the case. And then this last disadvantage I want to highlight is target company supply. As SPACs boom in popularity, there may be too many SPACs and not enough companies to acquire. This is super relevant and is a nice transition into the data here as brought to us by SPAC Analytics and SPACdata.com. You can see that there are currently 432 SPACs looking for an acquisition. That is a huge number of these things, and that totals 139,000 million. So that would be $139 billion is currently searching for a target right now. That's immediately looking for a target, not that's already closed. And what we've seen is already closed in the last couple of years. Here's 2020. First off, look at the number of SPAC IPOs, so the number of SPACs that were opened, 248, which hands down was a record for any year prior. But I'm a little surprised that it took this long for SPACs to get this popular, since it seems like such a convenient workaround to the IPO process that a private company might otherwise have to go through themselves. It might simply be a result of the exuberance we've seen in the stock market, especially lately, that people are being pushed further and further out the risk curve thanks to central banks and other actors. So maybe that is just the result of this. That's why it hasn't really occurred until now. But the same sort of benefits and drawbacks have been there, I would think, the entire time. So I'm not really sure why it's taken this long for these to really take off, but they really have taken off. This is an exponential curve if I've ever seen one. Went from 59 in 2019 at about 13 billion up to 83 billion in 2020. Most of that, I think, taking place in the back half of 2020. That was 248 SPAC IPOs. And just in the first 3 months of 2021, 298 SPAC IPOs at $96 billion in gross proceeds. That is an enormous amount of money flowing into these things, especially compared to what there was before. Up nearly 10x since the last high in 2019 at $13 billion, already at $96 billion just here in 2021. Lots of money floating around the system, and a lot of it is finding its way into SPACs. There's currently $139 billion looking for an acquisition right now, and another $38 billion that have announced a target. And then of all SPACs ever, 292 have actually completed an acquisition. So just this year, if half of the SPACs actually complete completed acquisitions. That would almost be the entire amount of SPACs that have ever closed ever. So it just shows you how crazy this environment is and how unprecedented it is, and why the SEC probably is now thinking, maybe we should get involved here because this is a workaround to this system that we've built. Because back to that Reuters article, the SEC may be worried about the depth of due diligence SPACs perform before acquiring assets and whether huge payouts are fully disclosed to investors. Those sponsor warrants, for example, said a third source. So they're kind of doing this on a secondhand basis, Reuters is, but this is a very new story, and we'll see what the SEC says as they continue their probe into it, since this is a massive space, lots of money, lots of potential for abuse, and it's really it goes kind of against the spirit of what the SEC has designed with the IPO process. I'm not saying whether the current system is great or bad, but the point of the system is disclosure and trying to protect individual investors at the expense of companies' ability to go public. We'd rather have, at least the SEC says, we'd rather have a system where investors at least have the ability to be informed, and there's less ability for fraud to take place, even if that means that less companies will go public because of the expense and the due diligence process and all that. The SPAC process kind of avoids a lot of that process. So it makes sense that the SEC would want to push back on this, because it really does try to limit the amount of information that companies need to disclose when they go public. Not that some will be fully transparent, but there is potential for fraud here, and we'll see more as everything kind of unravels as more and more of these SPACs are completed. We're just into the first year of this real frenzy, or just out of the first year, I should say, into the second one. So this is new, relatively speaking, and there's a lot that could happen and a lot that the SEC could do to try and eliminate the sort of efficacy of SPACs. But that's pretty much all I wanted to get into today. This is a big threat to the SPAC industry, and we'll see what actually happens and whether they're still worth it by the time the SEC is done with this. These things can take a very long time, so we might not get an update for many months or even past a year. We'll see what the SEC does, but I'll try to keep you posted either way. But if you like this video or found it informative, definitely like it, since that would help the channel out a lot. And if you like this sort of content about the financial markets and investing and personal finance, then definitely subscribe, since I put out new videos every single week and wouldn't want you guys to miss out. But until next time, take care.